Okay, awesome. So we are now recording and I'm going to get started with our presentation tonight. We are focused tonight, guys, on specifically research with mutual funds, research with investments, index funds, anything that you're looking at when you're trying to research, where to go next, right? Let me make sure this transition is turned off. I found out that was the trick of why my slideshows always speed up. All righty, play from start. All right, so again, we're going to be talking about the research to guys. I'm going to walk you through. I'm going to show you guys all the details, all the tricks and stuff to it, and then I'm going to show you how to actually go about and apply that knowledge. And then I'll open it up for Q&A. So very first thing is I look at it as the big three for research. So when I'm going out to research, let's say my index funds or ETFs or mutual funds, some investment, let's say my 401k or IRA, I'm going to these three resources 9 times out of 10. There's a million out there. And pretty much, you can use whatever is out there, but these are three big ones that are reputable. So I always call these the big three from a research perspective. And I say Yahoo Finance, MarketWatch, and Morningstar. So I have these all on my dashboard as a favorite that I always go to pretty much daily. The reason being is they have financial metrics built out for you. So some of you guys were probably in my presentation last week when we talked about the 10K specifically and how to dive into a 10K and, for individual stocks and really do some significant research. And a lot of that's, technical analysis or even fundamental research that you're looking into this 10K and you're kind of doing the recalculations yourself. The whole purpose of these, let's say the big three here, they kind of do that for you. So they would extract all that data for you and just put the metrics in front of you so that you don't have to go calculate and recalculate everything. It's kind of automated for you. So I really like Yahoo Finance specifically for that. On top of that, it's always going to have the latest news in the markets. It's going to have the Dow Jones, the S&P, the Russell 2000, all the markets, all the latest news, the latest stock news, latest company news, breaking news, all that kind of stuff. So it's a hub to not get carried away with. You don't want to react to every news story out there, but it's going to provide a lot of research and a lot of insight into these companies. And then you have Morningstar and as well for that. Plus, so author insights. I really like this piece of it. So you're going to have all these news stories, but you're also going to have the author insights into this. So a lot of these guys aren't just authors. They've actually experienced it and they've had some skin in the game. So they understand how things work. And so their professional advice and insight into the article that they wrote is also good because they're going to provide a different perspective than what you may gather initially from just reading their article. So I think it's very helpful to have that. Also understand though, that a lot of these news stories, like I said in bullet point 2, is these author insights could be biased. So you definitely want to be careful and kind of pick apart some of this information because some of them might, obviously get paid off by, let's say the news place they're working for. So definitely proceed with caution, but it's definitely some good information. And then at the bottom, you'll see here, the resources I typically use for all my research. So yeah, I go to Yahoo Finance, MarketWatch, Morningstar, but a prospectus and a fact sheet for every single investment I ever invested in or looked into, been interested in. I've always pulled up the prospectus and or fact sheet. The fact sheet is kind of a summarized version of the prospectus. The prospectus is the long, boring version. Let's say it's the book, and fact sheet is like the cliff notes of that. So it's just kind of highlighting the big points. So these are the 10 points of emphasis to research before buying an investment using the prospectus and or fact sheet. So these are the 10 points. If I'm going to go out there and look for something and, I get a question in the Wall Squad, hey, what do you think about X, Y, and Z? This is the process that I would go about to kind of go give you that answer. So number one, and we're going to walk through, I'm going to actually pull one up here after we're done with this and show you how to go about this, but investment objective. So the core, I guess, guiding principle in investing comes down to, do you know what you're invested in and what is its objective? What is it trying to accomplish here? Like if I go out and buy a stock, if I go buy an investment fund, do I understand what it's actually doing? Because a lot of people don't, believe it or not. And it sounds silly and it sounds obvious, but that's a big thing. A lot of people don't even know what they're invested in. They'll hear somebody invest in something and they'll just roll with it, but they don't understand. And so when the market's up and you're experiencing all these gains, everyone's excited. It's easy to get behind, but then you experience a downturn or some turmoil in the market, and those people that don't have that education backed behind why they're actually in this investment, it goes out the window and you sell. And so a lot of people buy high and sell low, and it's proven time and time after again with multiple studies is that's actually what people typically do, when you're supposed to really do it in the inverse, in reverse of buy low, sell high. That's the idea, right? Well, reality says that people do not do that because of human nature and how we're wired as human beings. We get excited when things go up, and so we catch it at the top, and then we get scared when things go down. So we do it in reverse order, although people are going to preach buy low, sell high. So you got to be careful with that. So make sure we understand the investment objective. So our example here is the VBLAX. This is a bond fund. So this is the Vanguard Bond Institutional Fund. The fund seeks to track the performance of a market-weighted bond index with a long-term dollar-weighted average maturity. Very simplistic, very to the point, and drives the overall arching perspective, point home. So number two, risk profile. And so some people might get this mixed up with a personal risk profile. So there's two different risk profiles. Risk profile when it comes to your on a personal basis, hey, are you scared of X, Y, and Z when it comes to the market? How do you react to certain situations? Do you know yourself well? That's risk profile on a personal perspective. A risk profile from a investment perspective is actually the investment itself. So if you guys go on to search these, you're going to see this is Vanguard. So you're going to see different, probably different looking charts slightly, but they're going to all be the same idea, right? 1 to 5 or 1 to 10, something like that. And they're going to kind of show you where this bond sits in relation to its respective benchmarks. And so you got to understand, there is this bond fund, but there's also a million out there. So you got to actually benchmark and understand the other ones in relation to this. So this is a good kind of gauge meter of where your risk lies by owning this fund. Depending on your age, you can probably, have a little more risk opposed to somebody that's a little older. That's like, hey, I want to go to the 1 or 2 side because I'm in, the preservation stage versus the accumulation phase of a younger investor, somebody that's willing to take on more risk. So here it says, this will provide the investor with an understanding of risk level in relation to other similar investment products. So just be aware kind of where your engaged or investment sits on this meter. And you obviously can click this button as well, guys. It's going to provide a little bit more insight into some of the more risk. Okay, so principal risk. A lot of people think risk profile and principal risk are the same thing. This is kind of hand in hand, but this is going to give you a really good insight. So again, if you watch the 10K presentation, when you look at a 10K, an individual company's annual report, you're going to see the risk factors on the 10K. So this is really similar in nature. They're going to talk about interest rate risk, as you see here, income risk, credit risk, index sampling risk, liquidity risk. There's so many risks that are associated with investing. So a lot of people think investing is a risky thing, and it is, but so is everything else. And everything has its level of risk. It's just how much risk are you willing to take? I mean, I always look at it as, hey, if you hold your money let's say in a bank account, a lot of people consider that safe. To me, there's risk of losing money to inflation. So this is the same idea here, is just because it says risk doesn't mean it's necessarily what you're probably perceiving as risky. There's just I guess there's some sort of chance per se in your investment. You just don't really truly know. There's no way of telling, hey, in 10 years, this investment's going to be at this level. There's zero chance of anybody knowing that. But you got to always think on the other side of things is, hey, my money in the bank, well, okay, the recent rise of Bitcoin, does that really devalue the dollar? There's risk there. So that would be the risk according to cash. So read these with a grain of salt. Make sure you don't read too much into these where you freak out and you don't invest. That's not the point here. The point I'm trying to drive home is just to understand where you sit in relation to the peer kind of investment funds. So now we have portfolio composition. So we understand what's the objective. We understand kind of the level of risk we're dealing with. Now we want to understand what's within this account, right? Or what's within this investment fund. So in our example here, VBLAX, we're going to look at this summary, of the total 100% of what type of bonds that are in here. So you have U.S. government, you have AAA bonds, you have AA bonds, and you have single A, and you have BAA bonds. What that means, and it's not that important for the purpose of this conversation to know what those types of bonds are, but from U.S. government to BAA essentially are least risky to most risky. So AAA bonds, U.S. government bonds are the least risky. It's backed by the U.S. government. That's 40% of this portfolio. And so when you look back at the risk, well, maybe that makes sense why they were kind of in the middle range of a 3 versus a 5 or a 4, because, well, it's U.S. government backed. If you watch the Fed lately, what they do, they just kind of control things. So they pull a lot of strings. And so the 40% is a significant margin. But then you kind of look at the AAA and you're like, well, there's no AAA. AAA are typically going to have lower interest rates because there's a very little default risk, which is a bond risk that you're going to have to deal with, is the default risk. Do they pay out what they promise to pay out? AA and AAA are really, really similar in nature. There's typically a very small margin of difference in these two types of bonds. Then you get into single A and then BAA, and they have a larger weighting in that, which is why it's not a 1 on the risk meter. It's kind of in the middle because you actually have a pretty significant portion in 30%, 50% between the two of those bottom ones in that, but it also has the backing of the U.S. government. So that's why you kind of fall in that middle tier range of that 3 out of 5 on a risk level. But to know what's in this investment, what you're actually buying and getting a portion of is good, because as you guys know, with index funds, with mutual funds, ETFs, it's not an individual company. You're buying a portion of a lot of different companies, bits and pieces. And so they're pulling from all these types of sources. So this is the distribution of the credit quality. And there's the organization that kind of gives the AAA ratings, or the bond ratings, essentially, is Moody's. You guys can look up. So portfolio characteristics. Now we've kind of deep dived into that. Now we're really understanding the details behind this. We want to kind of deep dive into it a little more. Sometimes, to be honest, if somebody asks me directly what this, what's my opinion on a specific fund, I usually dive into something like this right off the bat versus looking at the risk, because I can kind of gauge the risk as you become more experienced and stuff, and you read this stuff enough, you're going to start to understand all that kind of stuff with different factors and different pieces of the information. You're going to start to kind of put the puzzle together and make sense of, okay, this has 12.8 billion in assets, 2,500 in number of bonds. I can kind of gauge the risk by starting to see different characteristics of this versus really deep diving to every single point of emphasis that I'm making here. But as you see here, $12.8 billion in total net assets, the NAV. Number of bonds is 2,554. So there's a lot of companies are in this. You guys are covered by a ton. That's what I like about mutual funds, index funds, all that kind of stuff, is there's just a large majority. So your risk is, in my opinion, way lower with this, because you're taking a piece of the pie versus, betting on one specific. The average maturity is 25 years, which is a long time, long-term bond here. So when you look at this, you're like, 25 years, that's a quarter of a century. That's a lot of time. You don't really have to worry about something like this, especially when it comes to bonds. Bonds are already a low level of risk per se. And some people would say it's risky now in the current climate to invest in bonds, but in general, bonds have they're fixed income. So they're less of a risk in relation to like stocks and stuff. The average duration, 16.5 years, and yield to maturity is about 2.1% here. So just to kind of have a snapshot, high level is always good to have. So then fees and expenses. This is the thing I often talk about. I think the most important thing about investing is to understand your fees and expenses and taxes. But we won't get into taxes when it comes to your investments, because believe it or not, this is where people lose the most. And I've read enough white papers and enough books at this point to realize the difference between a top performing investor and an intermediate investor and a beginner, or I guess the least on the net return, is because of fees. They eat into your portfolio. A lot of people brag about their gross returns, but they forget about the fees and expenses that come with it. And a lot of people get those high returns because of the expenses that go into it, because it's expensive to try to beat the market and try to do all these different things. And a lot of different fees come into it. So I've had a presentation specifically on fees where I talk about all the fees pertaining to investments. And so you guys can go look back at that one. I'm not going to go into too much detail, but this is a screenshot of a few fees in VBLX. And so when I look at this, I look at sales charge, there's none. The load fees on both sides, the first and third line here. Redemption fee, there's none. The account service fee you can actually waive if you have a specific for certain fund balances above or below 10,000. So once you get above that, you can get that waived pretty quick. I know $20 doesn't sound like a lot, but it does add up depending on how much you have invested. And purchase fee of 0.5%. That is what it is. You have to be aware of it and see how that kind of plays into your overall returns. But to see this here is really important. So the biggest one is your expense ratio. So understanding the expense ratio and stuff with this is something big, because these are the biggest killers of individual portfolio performance. So principal investment strategies. This provides the investor with an understanding of the future of the investment product. So you want to not only see the investment objective, but you want to see where it's headed outside of just the beginning objective. You want to see what its plans are for the future. So obviously, year one, it might be a little different than year 5 or year 10. They may have a goal to ramp up investments or maybe scale back depending on what type of investment you're in. So think about target date retirement funds for your individual 401k. A lot of people are defaulted into those by their company. And early on, your investment risk is higher than when you get closer to retirement, because they purposely realign the stocks and bonds to kind of fit the investment strategy. And that's kind of what this is saying here, is understanding the whole strategy throughout the whole time of the fund being open versus just at this given moment when I'm investing. So that's going to, walk you through this. And then portfolio distributions, people get real excited about this one, especially because on the dividend portfolio and capital gains. So you can understand, you can look back and this is a very detailed, granular level that you're looking at. So it's, you might get caught up in too much detail here, but this is showing you every single record date of a dividend, the detail behind it, the reinvest date, payable date, reinvest price, all that kind of stuff on a monthly basis. So this is where I think Yahoo Finance and things like that are good, because if you look at this, I'm zoomed in here. So if you zoom out and you look at 50 years of data, it might get overwhelming. But if the yield behind a specific security that you're invested or interested in is 3% or whatever, that might be more appealing than looking at individual payouts. But at the same time, people might want to do their own calculations. So the detail is there if you need it, and you do your own analysis and calculation. So it's always there, and it's something that needs to be brought up as well. But this is going to show you that past performance. You always want to see good past performance, but you don't want to get caught up into it too much. And here I mentioned, for example, if I'm looking for a high paying dividend stock, the past payouts could be a key metric I would consider, obviously, but it's not everything. And that kind of leads us into this. So I think the past performance is important. So as you see here, this is the past performance. Now, you have to understand where this data lies. So here you see since inception, it's only been open since 2019. So you see 21% returns and you're like, oh, wow, this is the best fund in the world. Well, first off, it's a bond fund. So I would assume it's not. It's also whenever I pulled this data, so I don't know exactly 6/30/2020. So who knows what it's done since then, but 21% returns. A lot of people sit there and jump on this right away without understanding what they're really invested in. They skip all those first, the level of research I've already went through, and they see that they go straight to this. This is almost everyone's default first look. And I'm guilty of this. I think everyone is, right? Because this is the numbers. This is what we want to see, that ultimately we want the return at the end of the day. But definitely understand the what this really means to you. So past performance is not indicative of future results. So you got to be careful with just jumping on a hot stock or a hot investment because it's had a huge gains, because chances are, like we talked about in the beginning, where a lot of people get excited and they buy at the top, and then all of a sudden this investment gain turns into, let's say, 4%, and you go back to reality or come down a lot, and then you're disappointed, and then you sell at that 4% or the lower end of it. And so you just got to be careful. It's definitely a good metric to see. You definitely want to see a good track record behind your investment, but you don't want to rely on it as your deciding factor. Another thing here is it actually benchmarks against the Bloomberg right here, U.S. long-term government. So it's good whenever you're looking at any of these investments to benchmark against the competition or see it against other types of funds. This is the one it's actually tracking, so it's very similar in nature, obviously, but it's always good to benchmark. Like, let's say you're looking at individual stocks, to see that versus maybe the S&P 500, which is considered or deemed widely as the market, to see, hey, okay, this has 20% returns, the S&P has 18% returns, just to see how well it's performed in relation. So that's why I put a disclaimer here, because this is the most exciting piece of investing, I think. And usually exciting doesn't result in good returns, to be honest. And then the last one is recent news. So in this example, I actually looked up on Vanguard. They had zero recent news, which I kind of like in a way. That's kind of why I like Vanguard. But the reason being is because these news stories are always circulating. People are getting paid to write these stories and pump them out to get clickbait and all that kind of stuff. So while recent news is good, like let's say a recent transaction that happened, let's say Tesla partnered with, I don't know, I don't want to say Neo because that's a competition, but let's say they partnered with somebody on providing them X amount of resource in this department or whatever. And we knew based on that transaction that their sales would increase substantially and there would be a lot of buzz around something. Well, in that case, it might be good to know that story because you're looking at a long-term perspective of like, hey, in 20 years, this is going to be a huge impact in the market because they made this transaction or they announced this partnership. There was an allegation with one of the executives of fraud or something like that. So you want to be aware of stuff, but you don't want to be circulating this stuff day in and day out where it's kind of clouding your brain and your decision making to where you make bad decisions because you're reacting on a daily basis versus kind of seeing the big picture of things and understanding, okay, that was a huge transaction they just made, or that's a big investment they just made with research and development, R&D research. They're really gunning for the future type stuff. So that's why I say there's a disclaimer here. Don't get too caught up into it, but to understand the big picture things. Are they adjusting to the market? Are they keeping up with their competition? Stuff like that. So that's the end of my slideshow. I want to walk you guys through of how to actually go find that on the internet. So if you guys are just like, hey, I great presentation, but I need to actually go find this stuff. So if you're looking up a fund, I'm going to use the same one we've been using. So let's say VBLAX. So that's the ticker symbol that I'm searching. So Vanguard Long-Term Bond Index Fund of Admiral Shares, the long-winded version of that. It's typically like one of the first links. You're going to find it pretty fast. So you click on this. And so this is the fact sheet right here. So you can actually see a lot of these screenshots I took of like the fund facts, like the expense ratios right here at 0.7. Here's the product summary. You're going to find a lot of this stuff here. Here's that risk potential I was talking about. Here's your return. And if you guys see here now we were looking at 21% returns as of 6/30/2020, as of 3/31/2021, which I projected was 9%. And since inception, and look at the 1 year track record, -2%. So that's why I just say be careful with that quick analysis of like a big, game, because a lot of these investment funds are newer. Always check the inception date. It's always important to look at. Here's that characteristic. Here's the portfolio composition piece I was looking at. Again, this is Vanguard's. So I use Vanguard as an example a lot because I'm very familiar with it and I use it a lot. But if you, or with Fidelity, for example, if you look up the Fidelity bond fund, your homepage is going to look a little different, but all this information is going to be there for you. So if you go to like price and performance, you'll get some more stuff, more information. I mean, there's loads of information. This is what's considered the fact sheet, by the way. So I talked in the beginning about prospectus and fact sheet. So this is that highlighted Cliff Note version of where we're sitting. And here's the portfolio characteristics again, guys. And I think according to our slideshow, it's 2553 in the number of bonds. So they must have added some more bonds since 6/30/2020, which they often do. And you can even see this distribution's kind of slightly changed, I think. So and that's very normal. That stuff does change slightly, but the overall premise and goal of this is certainly stays on pace with the investment objective, principal risk, principal strategies, all that kind of stuff. But yeah, you can kind of, here's the dividend distribution history, long-term capital gain, dividend payout, short-term capital gain. So this breaks it all down for you. And then the news and reviews, there's still no news and reviews. It's a bond fund. It doesn't surprise me. There's not much. Now, if you want to look up the prospectus, so I'm going to go back up to VBLAX prospectus. A lot of this stuff is really, really quick to find if you guys just Google it. Let's see, view prospectus, and I think it's actually in here. Oh, here it is. Yeah, view prospectus and reports. So you can see here all these. Here's the annual report that you can get as well. But summary prospectus, you just click here and you would open this up. And so when you walk through this, as you can see, this is 8 pages. It's a bond fund, so it's not that long. Like I was saying, it's the long version. But as you see in here, here's that screenshot of those fees I was talking about, investment objective. So you'll see bits and pieces I talked about throughout here. Here's the operating expense ratio, 0.07. That's really important for you to look at. Here's the principal risk. So as you see, throughout here, some of these are a lot longer. So this is a 8-page one. This is nothing. You could read through that pretty fast. But if you look at like one of the bigger funds, or maybe ARC, for example, would be a good one to use. That could be 60 pages. That could be 100 pages. I've never looked it up personally, but those prospectuses can be long. So a lot of the quick thing I do is Control F, and I just search like keywords like fees or whatever I'm trying to look, just to kind of sift through the data if I have this, or I'll go ahead and use the fact sheet just to make it easier. So I hope that was good, guys. I kind of walked through what it was and then how to do it, but I want to open up for questions. So I saw some questions in the box. I want to answer those first, and then I'm going to open it up for conversation so you guys can talk in a second. So give me just a minute. I'll walk through this. What's it considered a high expense ratio and a low expense ratio? So I like to use the rule of thumb 0.2%. Tiffany put less than 1% for mutual funds. Some people like much lower, but to me, depends on 10-year plus returns. Yeah, so I guess it depends like what you have to understand, I guess. I like to use 0.2% to make it easy, less than that. But when you understand the impact of fees and long-term strategies and studies that you guys will learn about, most times is the actual gross returns of a lot of investors aren't too different. But the biggest thing is the reason people win is because the ones that don't have a lot of fees typically will win more often than not. So if you have a fund that technically performs, let's say 2% above the market and you're paying 1%, well, you're still net 1% above it, right? The problem is when you are actually doing this research and finding out the spread on a lot of these portfolios, you don't have that 2% beat by the market. Like you aren't going to beat the market by 2% often. So a 1% ratio, let's say you beat it by 0.75, but you have that 1% expense ratio. Well, then you're paying, that crazy amount. You're actually below on a net basis, 9.75 in that example, opposed to that 10%. So you would underperform the market in that case. So you got to be careful. 1% super high. I have an example in my book, actually, what 1% does on an example of, I talk about this a lot, so you guys might have heard me talk about it. For an example of, I think $500 monthly, 7% returns for 30 years. So you contribute $180,000. So your return with 0% fees, no fees, you basically are the market. Let's say you invest into a low cost index fund and you don't pay any fees really. You would get about 590,000 in that example. By 2%, 1% I think is about 180,000. No, sorry, 100,000 or so in fee expense. So you would deduct 100,000 or so with 1% there. And then 2% is 187,000 in fee expense. So you just got to understand like what kind of risk you're willing to take. I'm not saying, 0.15 and 0.48 are a couple I have. I feel like 0.48 is crazy high. Yeah. Like, I mean, again, so you're just going to have to deduct that from your gross return. And if you do study a lot of these studies I'm talking about, you're going to realize oftentimes it's just not worth it. Not saying you can't beat the market, not saying Kathy Wood's ARK fund isn't going to do crazy things and crush the market long term. But people look at and they get caught up in a year or even 6 months, right? A lot of people get caught up in 6 months increments and look at the returns and they're like, oh, this is 120%. Well, yeah, but it's a 6 month gap. Like we're talking 40, 20, 30, 40 years. We want to invest for the long term. We're not just investing for 6 months. So yeah, if you were in that fund for that 6 month period, you would get hit on short-term capital gains on top of that. So there'd be a tax implication of buying and trading within that 6 month window. But yeah, you'd probably beat the market because you would have way higher returns in the market in that short time period. But when you spread it out, it's been proven time and time after again, most large cap actively managed mutual funds aren't going to beat the index funds. In fact, from 03 to 2018, only 8% beat them. So you got to be very careful when it comes to that. Again, 0.2% is what I would say is the highest. That's like QQQ. If you guys are familiar with that fund, the NASDAQ, that's a really popular fund. That's sitting at 0.2. I highly recommend that. I like that fund a lot. But it's just, as you get higher, you have to understand it comes with a little bit of risk. So is there a class on how to find plays? What else do you have to look at other than annual return, future expectations and plans the company has, and looking at fees and stuff? Yeah, so Jerry, I don't have a specific class on like how I search my fees outside of like this kind of stuff. And I talk about it on my Instagram all the time. I know Chris has, I think he has like, I don't know which of the courses technically are plays, but he does have the whiteboard plays in the Wealth Squad every day. Like he'll post those plays live for you guys to use at your disposal. So that's where those would be. What else do I look at other than all that kind of stuff? So typically I would look at the 10K if it's an individual stock. So I did a presentation on individual stock research last week on 10Ks and stuff and like company filings. That's a Wealth Squad University if you guys are interested in watching that one as well. But other than that, I mean, it's really, I like to look at investing as a common sense approach. A lot of people think it's really detailed, right? And there's good stuff like this out there where you're looking at the emphasis and the research behind all this kind of thing, all this investment stuff, but just have a common sense approach. Like think of it high level. Like I like to look at it as like, okay, if I'm invested into Apple, I can realistically like common sense invest into that and realize I have a good investment without deep diving into all of these analytics and research and all that kind of stuff. Of course I could do that, but if I invest in Apple, like I think I could just make a common sense approach with that. Same with my index fund investing in a lot of big companies. Like I just kind of think about it from a logical perspective. Like for me, I'm a big S&P 500 guy. So I look at it as, hey, I own the US market essentially, right? Or VFX. Like I'm with the biggest 500 companies at any given time in the US stock market. I have a lot of confidence in the US stock market. My research doesn't have to really go beyond that, to be honest. Now I have to understand like my risk profile and different factors associated with that. But from a technical analysis, or deep dive into technical research, I don't necessarily need to do that. So that's kind of my answer, long-winded answer to that. So I really want to go above and beyond any of this stuff outside of, if you are doing any day trading or plays like that let's say you're interested in like Peloton or I don't know, PLTR, like on a short-term basis, then in that case, I would refer to Ray and Curly, because they're going to talk about the more technical analysis side. I'm more the fundamental analysis, to where I'm kind of looking at it from a informational perspective, and they're kind of looking at from a numbers perspective. Both sides have their benefits. So technical analysis and fundamental analysis both have their sides and benefits. You just have to understand what type of investor you are. Like me, I don't have enough time during the day to do all that kind of stuff. So I don't need to go make sure I know support and resistance and MACD indicator and all that kind of stuff. Like, it's not beneficial for me to do. I just know if I look at these kind of points of emphasis, I look at different things like that, I can just go ahead and invest in this and feel confident, because I'm just going to buy and hold anyway. I'm going to consistently dollar cost average into these investments. Like, it's nothing that I have to get like too caught up into. So just understand what type of investor you are, and you should be fine. Thanks for the tips. We'll definitely watch your other course. Yep. I have a few presentations. If anybody's new, we had a huge influx of new members. So I'm glad for anybody new here. Welcome. But Wealth Squad University is going to have a ton of different, we have nightly presentations. So we will have a ton of that kind of stuff. And I think we started this in January. So we've done pretty much a nightly presentation since January on different topics every single night, 5 days a week. So I think I've had at this point, maybe 5 or 6, maybe up to 8 or 10, I don't know. But you guys can just go scroll through that and you'll find a bunch of different topics. Every single week's kind of a different topic that we try to present on. So there's a lot of good stuff in Wealth Squad University. And lesson announcements is where everybody talks about it for like the updates and stuff, and when they're going to be. I see it now. Yahoo Finance, Market Watch, Morning Star. Oh, sorry about that, buddy. Yeah, Evan. Here you go, right here. So Yahoo Finance, Market Watch, and Morningstar are my 3 main research tools. Like I said, there's a million, and a lot of people have different preferences. I just think it's those are very strong, reputable ones. So, okay, so it looks as if I think I got through all the questions here. I'm going to open it up. We have about 20 minutes to go over any other questions. You guys can continue. If you don't feel comfortable talking out loud, that's fine. Just go ahead and type the message in here, or I'm going to take you guys take yourself off mute and just blurt out whatever you guys got. I know somebody's got a question. No one's left yet. We don't have to go the whole hour, but I always want to make sure you guys I have to provide the time for you to at least ask those questions. Is this targeted more for the index funds and bonds as opposed to stocks? Yes. Okay. So this is investment research for specifically any mutual fund, index fund, ETF. But when I say bonds, it's really a bond in mutual fund. So yes, the answer to that, I did a presentation on individual stocks last week or 2 weeks ago. So that's the 10K presentation you guys would see in Wealth Squad University. So I walk through like, hey, if you're going to actually look at an individual stock from a fundamental analysis perspective, like research perspective, like what you would look in for that. So I wanted to make sure I also touched on mutual funds, index funds, because I'm more the index fund guru and stuff. So I tend to do this, but I also my job, I essentially do 10Ks for a living. So I have a lot of insight into, the fundamental analysis side of things. So that's why I did one on that as well, because I know there's interest on both sides. When doing investment research for an individual stock, whether you plan on investing in shares or options, do you go through the same general fundamental analysis steps that you explained today, or is it different? Sometimes I feel like there's something I'm missing or doing something or something I'm not doing right. Yeah. So really, like I said, this is investment research when you plan shares and options. So I don't do options. Just to make that known, I do not do options. When you say shares, I'm assuming like individual stocks. I would go through pretty much all of this stuff, but like an individual stock's not going to have like all this information, like the investment objective, right? It's somewhat the same, but it's through a 10K. So you're going to look at their annual report. And so I'm not going to be like focused on risk profile. Like they'll talk about it in a different light within that 10K, but you're not going to see that fact sheet necessarily. Basically, the 10K is the replacement of that, or 10Q, which is the quarterly report, and that's going to give you that insight. So that's what I would go that way. If I did individual stocks or like options. If I did options, I would do purely technical analysis. I wouldn't really worry about the fundamental side too much. I would probably a little bit maybe look at some of this stuff, but if I was trying to make a play in a given day or swing trade or something like that, or just in options in general, like I would probably more so look at technical indicators that Ray and Curly talk about a lot instead of doing this stuff. So it just depends, I guess, what type of investment you're after, what's your goal with it. But if you guys have been following me for a while, I've been a long-term investor since the beginning. I don't really stray away from that. I don't have enough time to do anything on a day trading perspective or swing trading or options. So I don't really focus anything on that, but that's a Curly question. That's Ray. They're really good at what they do with the technical side of things. I do this for a living, guys. At my 9 to 5, I work for Deloitte as a manager. So we're auditors essentially. So what we do is really think of more of us as a consultant versus like an auditor cop, but we're like consulting and helping put together 10Ks for big Fortune 500 companies. We basically create the report for them and then technically audit them, but we consult the whole way through. And so I do this so much on a daily basis. So it's pretty much pointless for me to do when I get home. I'm hesitant to ask this question because it gives the impression I'm looking for a ticker to just throw money at. Totally fine. Guys, ask anything. It's not a big deal. But maybe for comparison purposes, like when you talk about Apple and say most people know it's a safe investment, what are a couple funds you would think are safe? Granted, goals can vary, so not every fund meets everyone's needs. I don't know if I worded that perfectly. Okay, so I think I get your point, Evan, with this. So like when I say a safe investment, I typically look for like big blue. So two things I look at: blue chip companies and dividend kings or dividend aristocrats. So dividend aristocrats or kings is just a company that's been listed on as a dividend king or aristocrat based on that they paid dividends for a consistent amount of time. The nature of a dividend is meaning that company is pretty stable. They've been around for a long time and they're really good at making money, but also distributing that money to their shareholders. So if I'm looking for a good long-term safe per se investment, I'm looking for a Coca-Cola, a Johnson and Johnson, and those big names. You can often just think about like your daily life. Honestly, like you look around your house, you see GE on your microwave or on your stove. You see Samsung on your TV, LG on your TV. Those big name companies a lot of times are what I consider there's no such thing as safe investment, but a big, nice, solid company. Nike, Coca-Cola, J&J, Moderna. I got my vaccine yesterday. So like I was there and I got a Moderna shot. Like that's an awesome company to invest in. Pfizer, things you hear often are those kind of companies I'm very accustomed and I feel very confident investing in. AT&T is a good dividend stock that is often talked about, all of those types of investments, things that you don't have to do a lot of research. So you basically go throughout your day and you see them out and about in your daily life. I don't own any, just a FYI, I actually do not own any individual stocks at the moment. Not against it, not saying I won't, but at the moment I do not. Um, if I were to invest into a stock, I would for sure, yeah, blue chips and dividend kings. I would for sure buy Apple right away. Um, Amazon, obviously their stock price is currently like north of 3,000, I think it was last time I checked, but they're bound to have like a stock split here soon. They've got to have more capital enter the market. So I would assume like those big guys are kind of who I would focus on. Tempest, tax harvesting. I don't want to give you too much. I don't. Let's connect offline on this one. I know briefly what it is, but let me see exactly what you're looking for, and let me see. I don't want to give out blanket tax advice over this is the problem. So let me talk about your situation offline. Just DM me or whatever. I mean, essentially, guys, what this is when you are able to offset your gains with your losses. So usually the number is like 3,000 that you're able to offset personal income tax with with that with your losses that you have if your losses can offset those gains. But again, it's very case by case basis. And as a CPA, I hate giving out blanket anything advice, especially tax advice, because I don't want anybody to run with thinking one thing and you go down a wrong path and something bad happens. So that's only out of protecting you guys. Another thing, actually, I'm going to make a very general comment on that. Tax harvesting is a great feature, right? But if you're losing money and you're offsetting your losses with your gains, you're losing money. So just be very careful with, I mean, use it to your advantage if you have to, but it's kind of like that thing where it's like, okay, be careful when it comes to, obviously you can play, your gains and losses and from a timing perspective, a tax timing perspective, and kind of benefit yourself. But just be very careful with that. The video will be available later. Like I said, guys, everything is saved in Wealth Squad University. So we have these nightly presentations, but after this, they'll be uploaded to Wealth Squad University for you guys to access whenever, which is awesome. It's basically, I think it's like the Netflix of personal finance. You guys could literally get on Wealth Squad. I do it with my wife sometimes. So I obviously don't give every presentation. I obviously don't know everything. So I have a lot to learn myself. And when I go through Wealth Squad University, I learn so much. There are Friday nights and Saturday nights. She's like, hey, let's watch Netflix. And I turn on Wealth Squad University and I start scrolling through videos like Wealth Dad, Decade Investor, Eric's ecom stuff, like just random stuff that I'm not really accustomed to, and learning about that. Curly Ray, just so much good information out there. So if you guys haven't been in Wealth Squad University, that's where all this information's at. Like the chats get busy, they're fast. People have a hard time catching up with them. They feel like they're overwhelmed. Just take it at your own pace. Go to Wealth Squad University, watch a video, ask questions. Feel free to always tag me in different things. I'm on Discord, obviously, as BudgetDog, but I also have my Instagram, my Twitter, everything there. So you guys can always find me on those platforms as well and DM me. I don't care where you DM me, but it's a huge thing. It's a melting pot of knowledge, honestly, Wealth Squad University. It's pretty impressive. And we actually just added a new provider. So Michael Crow was added, I think, yesterday. So that's going to be, he's going to have really, really good insight into individual stocks. I'm pretty excited to learn from him as well. Very, very knowledgeable, very thorough and stuff like that.
How many index funds would you recommend getting? And what's the benefit of having multiple index funds?
Yep, that's a great question. So when I think of index funds, I talk about this in my book. So I look at like 6 different factors, and I'm not going to get deep dive into every one of them, but I don't think there's necessarily a number. I think it's more coverage. So I know that's probably not the answer you wanted to hear. I personally own 2. And
Okay.
so if that gives you insight into what I think of a number, I don't think it's relevant. I think index funds in their nature, you own so many different stocks. So if you were looking at this presentation with the fund characteristics here, you guys see like 2,500 bonds are within this. So if you owned on an individual basis, 2,500 bonds, I would say you're really diversified. But if you own one bond fund, you might be like, hey, I'm not diversified. I disagree with that. I think you might be, depending on what you're trying to cover. I think as an investor, though, you have to look at like which areas you want to cover. So think about equities or stocks, right? So if you're like, hey, I want to be, let's say, properly diversified with index funds, but I need to understand that I am diversified. How do I know how many do I need? What do I need to be covered in? Think about like, okay, do I want domestic, like let's say the United States equities? Do I want international? Do I want small cap? Do I want mid cap? Do I want large cap funds? And so once you make that determination based on like the risk profile and all that age and all that kind of stuff, then you can just go find those funds that are fitting that style. So if you're like, hey, I came to the conclusion I want 60% in domestic equities, which is like US stocks, and 40% into international stocks, well, you can go find VFX, which is the S&P 500, set that as 60%. And then you could set VTIAX, which is the international, which would be 40%. And so you would have that 60% domestic split to 40% international, and you would only have 2 index funds. And that would cover you perfectly fine. And I think that's really reasonable, a 60-40 split like that. And you'd have 2 funds. Some people would say that's not diversified. I think 1 to 5 is plenty index funds, but given the nature of them. I think over 5, I think it's not bad. I'm not saying that there's something wrong with it, but I think you can get all the coverage you need within a max of 5 index funds.
Okay.
Does that answer your question?
Yep, sure
Okay.
does. I think there's like what Chris said is like basically like index funds and like certain stocks is kind of like boring. And so it's like if you want to like excitement, it's kind of like you want your hand in like a lot of different things. But if you're just like, I want long term and I just want to hold stuff, then just getting 2 or something is fine.
Yeah,
So
no, perfect. That's exactly what I often recommend.
okay, thanks so much.
Sure, anytime. Yeah, if you guys have been following me for a while on Instagram, Twitter, throughout the Discord, that's the kind of investing I do. I do long-term only. Again, I don't have the time. I have a little girl on the way, so the family is I'm going to be adding a family essentially. Like I have 2 dogs, a wife, a little girl on the way, and that's not going to stop anytime soon. So my time is limited. And so when it comes to investing, a lot of people think you have to be very active and like in the day to day to do this. You really don't. Like a lot of this stuff is just buy and hold. Some of the best investors out there, like Warren Buffett and stuff, like Warren Buffett's a different case, right? Because that guy's just a genius. But like for the most part, just buy and hold like low cost index funds or even individual stocks, like, and just don't get too caught up in the day to day. People stress themselves out too much with this. They're like, I don't know what to do because there's so much going on. This is a proven strategy that works and usually beats most people. I've talked plenty of times, so I'm not going to do it again, but you'll probably be in the top 15% of investors if you simply bought, let's say in that situation, bought and hold 2 index funds for the next 30, 40 years. You'll probably be in the top 15% realistically. All right, so guys, we have 5 minutes. I'm gonna keep it open at least till 9:30 so that you guys have a little more time if anybody has last minute questions. Again, if you guys need to connect with me on Instagram, Discord, Twitter, I have Facebook. I don't get on Facebook much, but like if you want to DM me, Instagram is probably the best chance, or Discord. But I also check my Twitter. I'm on all those platforms. You guys can always connect with me, follow my stuff, ask me questions. I get back to everybody. At this point, I've had 100% success rate with DM, so there is 0 pending. And after this chat, I'm sure there's going to be quite a few, but I make sure I stay on top of that. I usually voice message too. It's just a little easier and gives you guys more insight into the question that you guys ask. So there's a lot of free resources I give on top of that. There's investment tool. So my link in my bio and any of my profiles, you'll see a free investment tool. So you can compare, like, I think we have up to 40 different investment firms on there. You can compare and contrast different investment firms if you guys are curious of who to work with and stuff like that. Totally free. I have a free budget template as well. Obviously I have my Gumroad store, which I have my books and all that kind of stuff in there if you're interested, but tons of free resources, tons of free content. I post daily and try to give you guys as good insight as possible. It's a quiet crew tonight, guys. I'm not used to this. We only got 23 in here. All right, guys. It sounds like everybody's good. Thank you, Jerry. Appreciate it, man. Sounds like everyone's questions were answered. If you guys have any questions, do not hesitate to reach out to me. I get questions all the time saying, "Hey, I can't believe you answered." Like, my goal is, like, that's why I do what I do. So I will answer you. Don't be alarmed when I shoot you back a quick response. My goal is to help you. If I can provide any value of any sort and help you become financially independent, financially free, learn about one extra thing you didn't learn about, like, I'm here for that. So always feel free to reach out to me. With that being said, and FYI, my @ on all my social media is @BudgetDog. So you just spell it just like this right here. And you'll find me anywhere. So appreciate all the time, guys, tonight. I will be in contact with you guys probably early tomorrow, maybe even tonight through the Discord. So things been popping lately. I think we had 2,000 new people today. So good to see more people in there, supporting each other. A lot of good stuff in there. So appreciate your guys' time.